we want to start this topic. We want to start this topic called reconstruction. So let me introduce it. Now, whenever a company has been making losses, over a long period of time, it becomes difficult for that company to pay dividends to their shareholders. It also becomes difficult to ask members to mute their sound. Please mute. I'm told to request people to mute. So let me continue. So I was saying, you mute yourself. Okay, fine. So I was saying, when a company has been making losses over a long period of time, then it becomes difficult for that company to pay dividends and even to attract potential investors. Of course, no company or no investor, would want to invest in that company or in such a company where they keep seeing retained losses in the books, retained losses every now and again. No investor would want to buy shares in such a company. So if you are such a company which has been making losses over a long period of time, and therefore you are not able to pay dividends to your shareholders, you can't even attract potential investors to your companies, what is the most logical thing for you to do? The most logical thing for you to do is to reconstruct yourself as a company. It would be advisable that as a company you reconstruct yourself so that you start your activities from now onwards. You reconstruct yourself so that you start your activities from now onwards in a more attractive and profitable manner. Now, the aim of reconstructing a company, is to help the company to eliminate. The aim of reconstructing a company is to help this company to eliminate the accumulated losses. From the books. We don't want to show losses anymore in our books. So let's reconstruct ourselves with the aim of eliminating these accumulated losses from the books. So that's the purpose of reconstructing a company, to help the company to eliminate the accumulated losses from their books and to enable the company to start its activities from now onwards in a more attractive and profitable manner. Okay? Now, the question now comes, how do you as a company reconstruct yourself? There are two ways in which as a company you can reconstruct yourself. One way is through what we call internal reconstruction. That's one way you can reconstruct yourself, or you can reconstruct yourself through what we call external reconstruction. That is another way you can reconstruct yourself, through internal reconstruction or what we call external reconstruction. Let me introduce briefly what each of these two approaches entail. Now, if you decide as a company that you're going to reconstruct yourself through internal reconstruction, then all the stakeholders of the company will normally be called into a meeting. The stakeholders would include ordinary shareholders, maybe preference shareholders, debenture holders, creditors, and any other stakeholder of the company. So that we ask them, what are they willing to sacrifice in order to help this company to eliminate the accumulated losses? What are they willing to sacrifice to help this company to eliminate the accumulated losses? For example, the ordinary shareholders might tell us, we owe them 20 million. Maybe they are willing to write off 2 million from their capital. Preference shareholders, maybe we owe them 30 million and they tell us maybe they are willing to write off 4 million from their capital. Maybe debenture holders, we owe them maybe 40 million. Maybe they are willing to write off 5 million. Already you can see that we are trying to reduce the finances of the company. In other words, we are reducing the capital of the company. So some books will normally call this approach of internal reconstruction. Some books will call it capital reduction. Capital reduction. Okay? Now, meaning that the stakeholders will sit down and come up with a scheme of capital reduction. They come up with a scheme of capital reduction. So they will have to develop a capital reduction scheme. That is in essence what it entails internal reconstruction. The stakeholders of the company will be called into a meeting so that they tell us what they are willing to sacrifice in order to help this company to eliminate the accumulated losses. And we are saying, in other words, they have to come up with a scheme of internal reconstruction, or what we are calling a capital reduction scheme. They have to come up with a capital reduction scheme. Good. Now, that is in essence. We shall look at every one of them in details. We shall look at each of them in detail. Now, let's look at the second approach. How do you reconstruct a company through external reconstruction? Now, let us assume that we are reconstructing a company called A Limited. If we are reconstructing this company through external reconstruction, then another company, let's call it B, another company B will have to come and buy the business of the company that we are reorganizing. So company A, in other words, will have to sell. Company A will sell their business to company B. This company B is either another existing company or it could be a newly formed company. So in other words, we are saying when it comes to external reconstruction, another company would come and buy the business of the company that is being reorganized. Company A will sell their business. In other words, company A will have to liquidate themselves. Of course, they will need to liquidate themselves so that they sell their business to this other company. So when it comes to external reconstruction, we normally say it occurs where a company is liquidated. External reconstruction occurs where a company is liquidated and they sell their business to another existing company or a newly formed company. That is in essence what involves external reconstruction. That means another company must come in. That is all about, in brief, how a company can reconstruct themselves. So I want to go through back to the first approach. I want to go to the number one approach, where we want to go back and discuss in details this internal reconstruction. In details, what are the accounting entries of internal reconstruction? So let me introduce it first. Let me introduce it. This is internal reconstruction, which I said is also known as capital reduction. This is internal reconstruction. Now, what are the accounting entries for internal reconstruction? We have agreed that we call our stakeholders, ask them what they are willing to sacrifice in order to help this company to eliminate the accumulated losses. Okay? Now, listen. One group of stakeholders we called are the ordinary shareholders. Initially, their capital was 20 million. Let me assume that the capital of 20 million comprised of 2 million shares of shillings 10 each. Then when we called them, they said they are willing to write off 1 shilling per share. They are willing to write off 1 shilling each per share. So it means if our company had 2 million shares and they are willing to write off 1 shilling, then they are willing to write off a total of 2 million shillings in total. What should be the double entry? That's what I want to discuss. So our number 1 entry is with amount written off on share capital. With amount written off on share capital, you will go to that share capital account and reduce it by 2 million. Let me open an account here. So I want to assume this is my ordinary share capital, which has a balance brought down of 20 million. Let me put my figures in thousands, remain as 20,000. They are willing to write off 1 shilling per share. 1 shilling times 2 million, that is 2 million shillings. So we debit share capital to write off 2 million. We debit share capital by 2 million, and we shall be crediting an account. We shall be crediting an account we shall be calling capital reduction. We debit share capital and we credit this capital reduction. So we debit this share capital here and we credit capital reduction, and we come and say your ordinary share capital by 2 million. So that's our entry number 1, which says with amount written off on share capital, you debit share capital and you credit capital reduction. You debit share capital and you credit capital reduction. Okay, that's number 1. Now, before we go to number 2, there are some questions that tell you something like this. Listen, there are some questions that tell you something like this. That when the stakeholders met, they agreed to cancel the old shares, 20 million, and replace them with new ones. Maybe they agreed to replace them with another 2 million shares or shillings 9 each. They agreed to cancel the old shares and replace them with new ones worth 2 million shares of 9 each. How do you go about it? Let me go through that approach. They agreed to cancel the old shares, meaning the examiner does not give you, listen, the examiner does not give you the amount right off per share. He just tells you the stakeholders agreed to cancel the old shares and replace them or issue new shares, 2 million shares of 9 each. Let's cancel the old ones first. So you will go to the share capital account. You will go to that ordinary share capital account, which we are saying has a balance brought down of 20 million. We cancel them. How do we cancel them? By debiting share capital by 20 million, and we credit an account we are calling capital reduction. So you open an account called capital reduction. So you credit and you come and say ordinary share capital, 20 million. That way you have cancelled the old shares. Now replace them with new ones worth how much? 18 million. You're issuing another 2 million shares of 9 shillings each. So with the nominal value of the new shares, listen, with the nominal value of the new shares issued, you will debit capital reduction. You will debit capital reduction by another 18 million, and you will credit ordinary share capital. You credit ordinary share capital by 18 million, and you come and say a capital reduction by 18 million. So we are saying with the nominal value of the new shares issued, with the nominal value of the new shares issued, I am debiting share, capital reduction, and I'm crediting share capital. Now, listen, originally the capital was worth 20 million. I cancelled it by debiting share capital here, and I credited capital reduction. That is to cancel. Then now I'm replacing them with the new ones by debiting capital reduction by 18, and I'm crediting share capital by 18. So when you look at this share capital account, it means, when you look at this share capital account, it means that we are effectively writing off how much? We are effectively writing off how much? Somebody to chat, tell me, what do you think? If originally we had 20 million, I cancelled it. By debiting share capital, I credited capital reduction. Then now I'm debiting share capital again, no, capital reduction again by another 18 and crediting share capital by 18. Then it means effectively I'm writing off 2 million, which is the same as the original version of the question, where the examiner could have told you they agreed to write off 1 shilling per share. On the 2 million, we just had to write off 2 million. So what I'm trying to say is this. It all depends on the way the examiner has set the question. If he gives you the amount write-off per share, just get the total amount write-off, debit share capital, credit capital, reduction. If he tells you cancel the old shares and replace them with the new ones, then we are saying with the nominal value of the old shares, which is this 20, you debit share capital and you credit capital reduction. Then with the nominal value of the new shares issued, you will debit capital reduction and you credit share capital. That's our entry number 1, which either way, it's an amount we are writing off on ordinary. So let's go to number 2 now. Number 2, what is the other entry? Number 2 is with amount written off on liabilities. Don't forget, another group of stakeholders we called were the creditors and the debenture holders, for example. Those are providers of finances. They provide either in terms of goods or the finance in terms of debentures. Suppose we called the debenture holders and we asked them, what can you do for us? And they said they were willing to write off 5 million from their debentures. We owed them 40. It's a liability. So number 2 says, with amount written off on liabilities. With amount written off on liabilities, you will go to that liability account. We all know a liability is always a credit balance. Whatever balance it is, always a credit balance. So to write off that credit balance, you will debit liability and you will credit capital reduction, maybe by 5 million or whatever it is that the question tells you to write off. So you debit liability and you credit capital reduction. That's our entry number 2, which says what? With amount written off on liabilities, you debit liability, you credit capital reduction. That's number 2. We go to number 3 now. Go to number 3. Our entry number 3 says, listen, before I discuss it, we are calling a meeting of stakeholders. Suppose they agreed, in order to help this company to eliminate the losses, why can't we reduce some of the assets downwards? Why can't we revalue some of the assets downwards? Be it machinery, motor vehicle, furniture, building, and so on. If they decided to revalue some of the assets downwards like machinery and so on, then our entry number 3 says, with amount written off on assets, whichever the assets, whether machinery, motor vehicle, furniture, goodwill, whichever, we all know assets are again a debit balance. We all know assets are always a debit balance. Therefore, to write off this debit balance, whichever the amount you're writing off, you will credit the asset and you will debit this account we are calling capital reduction. That's our entry number 3, which says with amount written off on assets, you debit assets and you credit capital reduction. You debit assets and you credit capital reduction. Good. So that's our entry number 3. We now go to number 4. Number 4, I told you, what's the aim of reconstructing this company? We said the aim of reconstructing the company is to help this company to eliminate the accumulated losses. The aim of reconstructing the company is to help this company to eliminate its accumulated losses. Meaning, if you go to the P&L account of this company, you will find an accumulated loss. Listen, losses are always a debit balance. Losses are always a debit balance. When you go to the P&L account of that company, you will find a balance brought down on the credit side. On the debit, sorry. It's a loss. It has to be written off. We have to eliminate it. So our entry number 4 says, with accumulated losses written off, how do you write them off? Of course, you go credit P&L account, you credit P&L account, and you debit capital reduction. And you debit capital reduction, you come and say a P&L account, whatever it is. Okay? We are using our capital reduction as our operating account. We are using capital reduction as the operating account. So we are through with our entry number 4, which says with accumulated losses written off. You debit capital reduction, you credit P&L account. That's number 4. Number 5. Number 5. Now, before I discuss number 5, let me ask you 1 or 2 questions. Now, listen, we are using company A as the company that is being reconstructed. So company A wanted to reconstruct themselves, and so they called you. They know you are an accountant, so they called you and asked you to help them to reconstruct themselves. And they want you to help them to reconstruct themselves as from 31st of December, maybe 2023. They want you to help them to reconstruct themselves as from that day onwards. So what you will do, you will ask the company to give you all the information they can concerning the company. Let them give you their balance sheet, let them give you their income statement, and many, many other information that you will collect as at that date. Now listen, suppose as at 31st of December you realize that as at that date, this company has a contingent. This company has a contingent liability. As at that date, it has a contingent liability. I want to believe that this is not a new term to you. It's not a new term to you. You must have heard this term called contingent liability. I may not ask you to define for me what it is, but I may ask you to give me an example of a contingent liability. As a company, you may have a contingent liability. What are some of the examples of contingent liability? Somebody chat and give me an example of a contingent liability. Chat and give me an example of a contingent liability. Chat and give me an example of a contingent liability. Aha, pending lawsuit. Good. That's one of them. That's one of them. Any other example you could give apart from pending lawsuits? Okay. Let me use it for now. Let me use it for now to illustrate what I mean. Now, listen. One thing you need to know, listen. One thing you need to know is this. Contingent liabilities don't appear in the balance sheet. Contingent liabilities don't appear in the balance sheet. In other words, if you ask this company to give you their balance sheet as of 31st of December 2023, will you see a contingent liability in the balance sheet? The answer is no. Now listen. Suppose one of the suppliers has sued this company, and as of 31st December 2023, your lawyer has analyzed the case and seen that when the case will be decided, either as a company, we may be required to pay damages of 2 million, or we may not be required to pay that damages. In other words, if, please mute. Are there some people who have not muted? Please mute. Please mute. Please mute everyone. Please mute. If you have not muted yourself, please mute. If you have not muted yourself, please mute. I hope it's okay now. Just a minute. Let me see something here. Okay. So let me continue. I hope everybody has muted. Okay. So let me continue. So I was saying this. that suppose as at 31st of December, one of the suppliers has sued you. Yes, thank you. One of the suppliers has sued you, and they have realized, your lawyer has realized that if the case goes against you, you may pay damages of 2 million. If the case goes in your favor, you will not pay 2 million. So as a company, you have, okay, as a company, you have a liability. As of 31st of December 2023, you have a liability which is likely to crystallize, in the future, depending on the occurrence or non-occurrence of a future event. It's a liability that is likely to crystallize depending on the occurrence or non-occurrence of a future event. If the case goes in your favor, you don't pay. If the case goes against you, you have to pay. Listen. But then the question is, if you ask for the balance sheet as of 31st of December 2023, will you see that liability of 2 million in the balance sheet? The answer is no. Are we likely to pay 2 million? Yes. So we normally define a contingent liability as a liability which is likely to crystallize in the future depending on the occurrence or non-occurrence of a future event. We are giving an example here of law cases, suits, maybe lawsuits, maybe warrants. Somebody is also giving me warrants as another example. That's correct. Okay. Now, what do you do? Listen to this now. We are going back to our reconstruction. What do you do when you realize that as at the date you want to start reconstructing this company, you realize that the company has a contingent liability? I have said it is not in the books. What do? You are now required to crystallize that liability immediately. You are required to crystallize that liability immediately. In other words, make it a liability in the books. Before I talk about how to make it a liability in the books, let me use another illustration. Now, when we called a group of stakeholders here, one of them were these preference shareholders. Suppose our company has a 10% preference share capital worth 10 million or 30 million. Our company has a 10% cumulative, let's call them cumulative preference share capital of 30 million. You know, if you have 10% preference shares, every year as a company you're required to pay them dividends at a rate of 10%. They earn a fixed return. So every year I'm supposed to pay them 3 million. But our company has been making losses, so we can't pay them the dividends. What do? Does it mean that they will lose their dividend? The answer is no. As a company, we just keep accumulating. Now, suppose the question tells you we have not paid them their dividends for the last 3 years. So effectively, we owe them a total of 9 million. Listen. If you go to the balance sheet of this company as at 31st December, will you see a liability called preference dividends in arrears of 9 million? The answer is no. You will not see a liability of 9 million in the balance sheet. We just know, listen, as a company, we just know that we have not paid them for the last 3 years. In future, when we shall make profit, we shall pay them. But if you look at our balance sheet, it doesn't appear in the balance sheet. But we owe them. So that is another example of a contingent liability. It's a liability that is likely to crystallize in the future, depending on the occurrence or non-occurrence of a future event. When we shall make profit, we shall have to pay them. Now, so we are using another example as preference dividends in arrears to be another example of a contingent liability. For your exams, most of your past paper questions use dividends in arrears as an example of a contingent liability. Let's go back now to our entry number 5. Now that you know what's a contingent liability. Now, so number 5 says, whenever you are reconstructing a company and you come across a contingent liability, that liability, I've already said, it should be crystallized immediately. So how do you crystallize that liability? In other words, make it a liability. So you will debit capital reduction. You will debit capital reduction with that contingent liability, and you will credit the account we are calling contingent liability. You will credit the account we are calling that contingent liability. This is contingent liability by whatever the amount. Listen, if the examiner gives you the name of your contingent liability, meaning it's specific, like we have said, preference dividends in arrears, then you will open a liability account in that specific name. So if it's preference dividends that are in arrears for the last 3 years, being a contingent liability, you crystallize it by debiting capital reduction, which is with what we are calling preference dividends in arrears, and you credit that account called preference dividends in arrears. You credit the account called preference dividends in arrears as a liability account. Listen, some questions tell you that the stakeholders decided, now that we owe them 9 million, immediately we start reconstructing, we shall pay them that amount. So if the question tells you that the liability was paid for immediately, you crystallize it first because it's not in the books, but then they decided they will pay it immediately. But to pay it immediately, you will have to debit that contingent liability, whichever it is, and you credit bank or you credit cash, whichever form of payment you are using to pay them. Okay, good. That's our entry number 5 that says, with any contingent liability arising, you debit contingent liability, you debit capital reduction and you credit contingent liability. Then I've said if it's paid for immediately, you debit the contingent liability and you credit bank. Good. That's our entry number 5. Number 6. Now listen to number 6. Now, for number 6, I go back to this account we are calling capital reduction. Now, I told you we are using capital reduction as our operating account. We are using capital reduction as our operating account. Meaning, once you implement all the transactions that you have been given, normally, this account should be self-balancing. This account should be self-balancing. Once you implement the transaction, the account should be self-balancing. But there are times when this account may not balance. There could be a balance. In most cases, you may find the balance could be on the debit side. And so we are saying, if there is a balance in this account, that balance should be considered as a capital reserve. Therefore, you will debit capital reduction and you will credit this account we are calling capital reserve. It could be either debit side or credit side, whichever way. But we are saying that the balance in this account should be considered as a capital reserve, whether positive reserve or negative reserve. Okay, those are the 6 official entries in the books of the when you are dealing with internal reconstruction. Number 1, I've said, with amount written off on share capital, debit share capital, credit capital reduction. Number 2, with amount written off on liability, debit liability, credit capital reduction. Number 3, with amount written off on assets, credit asset, debit capital reduction. Number 4, I've said, with accumulated losses written off, you debit capital reduction, credit P&L. Number 5, we have said, with any contingent liability arising, e.g., preference dividends in arrears, we have said you debit capital reduction and you credit preference dividends in arrears. And if it's paid for immediately, you debit preference dividends in arrears, and you credit bank. Finally, with the balance in the capital reduction account being a capital reserve, most times it's on the debit, you will debit capital reduction and you credit capital reserve. Good. Those are the 6 official accounting entries. Before we put them down, I want to go back to number 4. I said with accumulated losses written off. Listen to this now. Some of your past papers, they don't remind you to write off the accumulated losses. At number 4. The question will talk about share capital, it will talk about liability, it will talk about assets to be valued downwards and so on. It will talk about preference dividends in arrears being 2 years or 3 years in arrears. But some questions don't mention anything to do with accumulated losses. Listen, but whether the examiner reminds you or he does not remind you to write off the accumulated losses, listen, you should remember what is the aim of reconstructing this company. We said the aim of reconstructing the company is to help the company to eliminate these accumulated losses. So whether the examiner reminds you or he does not remind you, it is your responsibility to remember the aim is to eliminate the losses. So if he does not remind you, once you have implemented all the other transactions he has given you, remember to write off the accumulated losses. Because the company will always actually have made loss. And that's why we are reconstructing it, to help this company to eliminate the losses. Okay? So that number 4. Sometimes the examiner reminds you, sometimes he doesn't. Most questions, he doesn't. He just keeps quiet. But it is an entry you must remember to implement. Good. So before we move on, let's put down what we have said. So put down the subtopic. I hope we are all together so far. Are we together so far? You say yes. I want to see the chart. You chat and say we are together so far. Are we together so far? Yes. Okay. Good. If we are together so far, fine. We are together. Thank you. Let's move on now and put down something. So put down the topic, reconstruction. Reconstruction. Put down the topic, reconstruction. A reconstruction. Then you say this. Then you say this. If a company has been making losses, if a company has been making losses over a long period of time, then it becomes difficult. For that company to pay dividends, and even to attract potential investors. Becomes difficult for that company to pay dividends and even to attract potential investors. Please stop. Continue. Therefore, there may be a need. To reconstruct such a company. Another paragraph. The aim of reconstructing a company is to help the company. The aim of reconstructing a company is to help the company to eliminate The aim of reconstructing a company is to help the company to eliminate the accumulated losses from the books of accounts. The aim of reconstructing a company is to help the company to eliminate the accumulated losses from the books of accounts. From the books of accounts. The aim of reconstructing a company is to help the company to eliminate the accumulated losses from the books of accounts and to enable the company to start its activities in a more attractive and profitable manner. And to enable the company to start its activities in a more attractive and profitable manner. And to enable the company to start its activities in a more attractive and profitable manner. Another paragraph. Reconstruction may either be number one, internal reconstruction. Reconstruction may either be number one, internal reconstruction. Number two, external reconstruction. Number one, reconstruction may either be number one, internal reconstruction. Number two, external reconstruction. I've said reconstruction may either be internal reconstruction, number one, number two, external reconstruction. Then have another subheading, internal reconstruction. Internal reconstruction. Internal reconstruction. Then you say this, internal reconstruction. Internal reconstruction. Then you say this. This occurs where the capital of the company. This occurs where the capital of the company is reduced. This occurs where the capital of the company is reduced through a capital reduction scheme. This occurs where the capital of the company is reduced through a capital reduction scheme. Through a capital reduction scheme. This occurs where the capital of the company is reduced through a capital reduction scheme. Through a capital reduction scheme. Another paragraph. The following are the accounting entries. The following are the accounting entries for internal reconstruction. The following are the accounting entries for internal reconstruction. The following are the accounting entries for internal reconstruction. Let's put them down. Number one. Number one, with amount written off on share capital. Number one, with amount written off on share capital. With amount written off on share capital. Debit, share capital. Debit share capital. Credit capital reduction. Debit share capital, you credit capital reduction. We are not saying which share capital. It could be preference, it could be ordinary, doesn't matter. Debit share capital, you credit capital reduction. That's number one. With amount written off on share capital, debit share capital, you credit capital reduction. Before we go to number two, andika hapo chini NB, note, and you say this, NB, note, where the old shares have to be cancelled, and replaced with new ones, where the old shares have to be cancelled and replaced with new ones, where the old shares have to be cancelled and replaced with new ones. Number A, under that, number A, with the nominal value of the old, shares, with the nominal value of the old shares cancelled, with the nominal value of the old shares cancelled, debit share capital, credit capital reduction. Debit share capital, credit capital reduction. With the nominal value of the old shares cancelled, who is this that has not muted? Who is this that has not muted? Please, Uda, mute yourself. Who else? Who else? Please mute yourself. Mute yourself, please, so that we move together. Okay. So I was saying number one, or number A. I was saying number A, with the nominal value of the old shares cancelled. I was saying you debit share capital, you credit capital reduction. Okay, that was number A. B, you say this, with the nominal value of the new shares issued. Number B, with the nominal value of the new shares issued, with the nominal value of the new shares issued to replace the old ones, with the nominal value of the new shares issued to replace the old ones, with the nominal value of the new shares issued to replace the old ones, with the nominal value of the new shares issued to replace the old ones, debit capital reduction, and credit share capital. Debit capital reduction and credit share capital. Debit share capital, debit capital reduction, credit share capital. Somebody saying mercy, please mute. Okay. Okay. So let's go to number 2. If you are through with number 1, I was saying number B. I was saying with the nominal value of the new shares issued to replace the old ones, I said you debit capital reduction, and I said you credit share capital. Let's go to number 2 now. Let's go to number 2. Let's go to number 2 now. Number 2, with amount written off on liabilities. 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 Debit liabilities. With amount written off on liabilities, you debit liabilities and you credit capital reduction. With amount written off on liabilities, you debit liabilities, credit capital reduction. Okay. That's number 2. Let's go to number 3. Number 3. Number 3, with amount written off on assets. Number 3, with amount written off on assets. Number 3, with amount written off on assets. With amount written off on assets. Debit capital reduction. Debit capital reduction. Credit assets. With amount written off on assets. You debit capital reduction, you credit assets. I hope I've muted everybody now. I hope I've muted everybody now. Somebody was saying I muted from my end. Is it clear now? I've muted everybody now. Is it clear now? I've muted everybody from my side, so I want a comment. Very clear. Very clear. Thank you. Sawa. Sawa. So let's go on. So I was saying, number 3, with amount written off on assets, you debit capital reduction, you credit assets. Let's go to number 4 now. Let's go to number 4. Let's go to number 4 now. Number 4, with accumulated losses written off. Number 4, with accumulated losses written off. With accumulated losses written off. Debit capital reduction. Debit capital reduction with accumulated losses written off. Debit capital reduction. Credit profit and loss. Credit P&L. Debit capital reduction. Credit P&L. That's number 4. Number 5. Number 5. Number 5. With any contingent liability arising. With any contingent liability arising. With any contingent liability arising. E.g. preference dividends in arrears. With any contingent liability arising. e.g. preference dividends in arrears, e.g. preference dividends in arrears. Debit capital reduction, debit capital reduction. Credit contingent liability, debit capital reduction, credit contingent liability, debit capital reduction, credit contingent liability. Then under that you write NB, NB, under that you write NB. Then you say this: if the liability is paid for immediately, if the liability is paid for immediately, if the liability is paid for immediately, debit contingent liability, debit contingent liability, credit bank. Debit contingent liability, credit bank. That's number 5. Number 6 and the last one. Number 6 and the last one. Number 6 and the last one. With any balance remaining, number 6, with any balance remaining in the capital reduction account, with any balance remaining in the capital reduction account, with any balance remaining in the capital reduction account, being a capital reserve, with any balance remaining in the capital reduction account, being a capital reserve, being a capital reserve, debit capital reduction, debit capital reduction, credit capital reserve, debit capital reduction, credit capital reserve. Those were the 6 entries that we've mentioned. To finish, I want to mention 1 or 2 other things. Okay. Okay. Now I want to take you back. I want to ask you 1 or 2 questions. I want to ask you 1 or 2 questions on what you have already said. So you will answer me the following. Now let me go through. I want to take you back to some of the entries we have mentioned. Listen. Number 1, we said, listen to this now. Number 1, we said, with amount written off on share capital. So I came to the share capital account. I debited share capital. You remember with the 2,000, and I said you credit capital reduction. Listen carefully. Originally, the capital was worth 20 million. That's what we as a company, we owed the shareholders. They were willing to write off 2 million. So I had to debit share capital by 2 million. I had to credit capital reduction. My question to you is this. Listen. Is that a gain to the company or is it a loss to the company? We called the ordinary shareholders and they were willing to write off 2 million. So as a company, we debited share capital and we credited capital reduction. So the question is, to the company, is that a gain or is it a loss? Somebody has said it's a gain. Thank you. That's correct. So it's true, it's a gain. Thank you. It's a gain because we are reducing what we owe as a company. We are reducing what we owe to the shareholders. So to us as a company, that is a gain. That is a gain. Number 2, we said with amount written off on liabilities. You remember I told you liabilities are always a credit balance. So we have to debit liability by whatever the amount, and we have to credit capital reduction. Question again is this: is that a gain to the company or a loss to the company? We called in the shareholders, the debenture holders, and they were willing to write off 5 million. So we had to debit the debenture account and to credit share capital reduction. Is that a gain or loss? Again, it's a gain. Why? Because we are reducing what we owe. We are reducing what we owe to the debenture holders. So to the company, that is a gain. Good. Number 3, we say with the amount written off on assets. We say the assets are always a debit balance. So we credited the assets and we debited capital reduction. Question is, to us as a company, is that a gain or loss? To us as a company, is that a gain or loss? Somebody has said it is a loss. Correct. Why? Because we are reducing the value of our assets as a company. We are reducing the value of our assets as a company. That is it. Then somewhere I took you to contingent liability. I told you something like this, that because we are reconstructing our company as of 31st of December 2023, I said, the moment you realize that this company has a contingent liability, I said you should crystallize that liability immediately. Don't wait until the future event. Now that we are reconstructing the company, crystallize it. Meaning, listen, before we reconstructed, yes, we still owed the shareholders, the preference shareholders, dividend of 9 million. But now that we are reconstructing, I was required to crystallize that liability immediately, the 9 million. So before we started reconstruction, we did not have that liability in the books. Before we started reconstruction, we did not have that liability in the books. But from now onwards, we shall be reflecting a liability of 9 million in the books. Question is, a gain to the company or a loss to the company? Before we reconstructed, in our balance sheet, we did not have a liability. Now that we are reconstructing, we had to crystallize that liability, which we gave an example as preference dividends in arrears. The question is, once you crystallize it, does that make you suffer a loss as a company, or will you have a gain? Good, that's correct. It's a loss. Why? Because before we reconstructed, we had zero liability. Now we have a liability of 9 million. Our liabilities are increasing, therefore automatically that's a loss to the company. Good, that's a loss to the company. Now listen, with those 4 entries, listen, with these 4 entries, I hope you have already noticed something. You have already noticed something. What is it that you have noticed? I hope you have noticed this, that every time our company made a gain, that gain was being credited in the capital reduction. And every time our company was making a loss, that loss was being debited in the capital reduction. Listen, I've taken you through this because, listen to this now, because some of your past paper questions give you some transactions which are not among the 6 official entries that we have mentioned. It gives you an additional information, maybe number 7, number 8, which is not among the 6 official entries. But the question is, you'll ask yourself, when I implement this transaction, will the company make a gain or will it make a loss? If you realize that by implementing that particular transaction, the company will make a gain, then that gain should be credited in the capital reduction. For example, the question might tell you share premium to be written off. Among the 6 entries we have mentioned, there is nowhere we have talked about share premium. But now the additional information says share premium to be written off. We know share premium is an amount that belongs to shareholders. And share premium is always a credit balance. If I'm going to write it off, I go to that share premium account which has a credit balance, whatever it is. I will be required to debit that share premium to close it. And I go and credit capital reduction. That's what we are saying. You debit share premium, you credit capital reduction. Why are we saying it's a gain? Because I have said this is an amount that belongs to shareholders. If we are writing it off, we as a company, therefore, we are reducing what we owe to the shareholders. We are reducing what we owe to the shareholders. It could be something like general reserve, revaluation reserve. They tell you to write them off. These are things that belong to shareholders. Share premium, general reserve, revaluation reserve, they belong to the shareholders. So if the question tells you to write them off, obvious, as a company we are gaining. What if the question tells you, in the process of reconstructing this company, our company had to spend 2 million shillings to reconstruct. That means we had to incur a reconstruction cost of 2 million. It's obvious. As a company, that's a loss to us. We are spending money to reconstruct the company. Therefore, being a loss, that loss must be debited in the capital reduction. So you will debit capital reduction by that 2 million. You will credit bank. We are spending 2 million to reconstruct the company. So you debit capital reduction and you credit bank with the amount incurred as reconstruction cost. Good. So that's what I was trying to say. Remember that reconstruction cost is not something we mentioned among the 6 entries. But maybe an additional information tells you the company had to spend 2 million shillings to reconstruct themselves. That's a loss to the company. That loss have to be debited in the capital reduction. Good. So with that idea now, let's go back to the notes. Let's go back to the notes. Below there, andika NB. Below there, andika NB. NB. Then you say this. NB. NB. Any gain made by the company. Any gain made by the company in the process of reconstructing itself. Any gain made by the company in the process of reconstructing itself. Any gain made by the company in the process of reconstructing itself should be credited. Should be credited in the capital reduction. Should be credited in the capital reduction. Should be credited in the capital reduction. E.g., share premium to be written off. E.g., share premium to be written off. Stop. Go on. Any loss made in the process of reconstructing a company, any loss made in the process of reconstructing a company, any loss made in the process of reconstructing a company should be debited in the capital reduction. Any loss made in the process of reconstructing a company should be debited in the capital reduction. Should be debited in the capital reduction. E.g., reconstruction cost being incurred. E.g., reconstruction cost being incurred. E.g., reconstruction cost being incurred. Okay. Now that we have talked about internal reconstruction, We are now in a position to do a question from your past papers now regarding this. We are now in a position to do that. But today I wanted to introduce the topic up to there so that next time, what if there is issue of shares? What do you mean by issue of shares? It depends on how. If the company is issuing them for cash or is it issuing them for free, it all depends. You know that's normal double entry. If they're issuing shares, I hope you are not talking about issuing shares to replace the old ones. That one we talked about. I am hoping you are asking the company issuing fresh shares. Is that what you're asking? You are saying, what if there was issue of shares? Is it fresh issue of shares? Ama the purpose was to replace the old ones that were cancelled? Reissue. If it is to replace the old ones, we have already talked about it. If it is to issue new shares, then you just debit bank and credit share capital. Okay? If you are given that they issued bonus shares, which in most questions of the internal reconstruction, they don't do it, then you know bonus shares are shares issued for free, and whenever a company issues shares, they must finance it from a reserve somewhere. So the question will tell you, if it's bonus shares, they might tell you it was financed from this reserve, maybe share premium, or it was financed from the general reserve, whichever the source. You debit that source. If it's share premium, you debit share premium, you credit share capital. If the bonus was financed from general reserve, you debit general reserve, you credit share capital. That is if they're issuing fresh shares, either by way of cash or by way of bonus. That one you record it in the normal accounting entry. The other one is where we were discussing they cancelled the old to replace them with new ones so that they can reduce the value of the shares. Okay? Good. Now, I was saying we are not in a position to do a question now. Maybe we can attempt a question next time.